Hi, everyone. So, welcome to the stream today, and welcome to the second episode this week in our discussion for the ICAG examination as we look at some practice questions when it comes to some of the key areas that we need to understand as we get ourselves into the exam hall. In case you've missed any of the previous sessions, you can check on the YouTube podcast session, the IFRS masterclass session, and you'll be able to watch the playback of all of the previous videos so that you can really flow through the discussion. Today, we want to focus primarily on two core accounting standards, and that is going to be IAS 33, earnings per share, and then IAS 12 with some element of IAS 16, property, plant, and equipment. So in principle, we are going to be looking at IAS 16, property, plant, and equipment, IAS 12 together in a given question. Then we'll look at IAS 33, earnings per share, how the rules are going to be applying. Remember that the examination is currently ongoing, or registration has opened for the November 2025 examination, and you can register to start for the exam. You can actually register for the exam. Then also, if you want to register, get access to our content, register for our courses, you can visit our website, NhyiraPremium.com. Boom, and you'll be able to get access to the content study under my mentorship with a team here as we assist you so you can take your life to the next level in that case. So let's see what we can do today. Let me bring up my screen quickly, and then we can get excited into the discussion for the day. We're still talking on the July, so this is ICAG, July 2025 corporate reporting paper. July 2025 corporate reporting paper. We are in question 2. We've answered the A aspect of that question. We've looked at the B aspect is what we are coming to today. We've looked at the C aspect also already. So we want to look at these areas in this particular flow. So B, that is going to be on IAS 33, earnings per share. We want to see how this one looks like. So required, it says, in accordance with IAS 33, earnings per share, calculates the basic earnings per share figure for the year ended 30th June 2025. Okay, so basic earnings per share. Basic earnings per share. Now we know earnings per share or basic earnings per share. Let me go straight up into my slide here. Basic earnings per share is parties, profits attributable to equity shareholders, all right, divided by the weighted average number of equity shares. Sometimes we can multiply this by $100 or £100 or 100 Ghana cedi, so that we can get the answer in the smallest unit of the currency. And I'm going to illustrate that to you in a moment. But that is the formula for the earnings per share. Profit attributable to equity shareholders divided by the number of equity shares. Now, under basic earnings per share, usually the profit attributable to equity shareholders will not require any adjustment. Once you get that figure, most of the time, we are not going to be requiring any adjustment. However, when it comes to the weighted average number of equity shares, that has to be calculated for depending on the context of the question. And that is what we want to look at in this case. So basic earnings per share, profit attributable to equity shareholders. Sometimes we can say the profit or loss for the year divided by the weighted average number of equity shares. So let's come back to the question and let's see what we have here. Zabzugu, a parent company, had 6 million 1 Ghana cedi fully paid ordinary shares outstanding at 1st June 2024. Now, I need you to be mindful of what is going on here. At the beginning of the year ends on 30th June 2025. So it means the year starts on 1st July, okay? On 1st July 2020, or 1st July every year. And so if says 1st June 2024, that's the beginning. We'll assume that yes, that's the opening share capital or the outstanding share capital. And we'll come back to that in a moment. Then he says, on 1st October 2024, the company made a consolidation of existing shares in issue. They made a consolidation of existing shares in issue. That is a reverse share split. That is very important. Reverse share split. Reverse share split. So the concept of reverse share split is simply that in the previous year, the entity might have undertaken a share split, and in the share split, what happens is that you are getting a lot of shares, but the same value. So in other words, a share split will look like this. I want to see if I can bring down something here. So let's say the nominal value of the share is 1 Ghana cedi. So 1 Ghana cedi gives you 1 share. The company can do a share split and say, oh, now we will have each share being 0.5. So what it means then is that with your 1 Ghana cedi, you now have 2 shares. That is share split. So if you come to this the context of this question, where the question is now saying that the entity has done a reverse share split, it means we are coming back to the original as it was. And we'll come back to that in a moment. At nominal value for 2 for 3. What does that mean? It means then that you are getting 2 new, literally, if you now have 3. Okay? So you get 2 new if you have 3 already or existing. Sorry. 2 over 3. 2 over 3. So that is very important for us. We'll come back to that as well as we build a story up. So that is a share split. Now, why is this information important? Because it means then that we have to calculate our weighted average number of equity shares. So let's set up that workflow quickly. Weighted average number of equity shares. That's wins. And so we're going to have dates coming up if we want to. And then in the second column, we'll have the outstanding shares. Let me present it this way. Outstanding shares. Then we will have the timing ratio, because the time period that a share has been. Now, this is a share split, and so we're going to have a bonus fraction coming up. Then certainly we'll have the average in the final column. So this is our schedule. So let's begin the journey. On 1st June, so 1st June 2024, we are told that we have an outstanding share of 6 million. So 6 million shares. Now, then the next thing that came to mind was 1st October. 1st October. Now, if we are working for the year ended under review, as I mentioned earlier, if the year is ending on 30th June 2025, then it's starting on July. So we're going to have July, August, September, right? Because that's the beginning of the year technically. July, August, September for the year under review. So maybe let me actually use that for the beginning of the year in the workflow. So 1st July 2024 to 30th September 2024. So July, August, September, that is 3 months. So the timing ratio is going to be 3 over 12. Stay with me. Then on 1st October 2024, we are told something happened. So let's see what exactly happened there. It was then that, where's the Okay, here. It was then that they did a 2-for-3 share split. All right? A 2-for-3 share split. So the question we then have to ask ourselves is, how did that come by? Permit me to do some workflow down here. I could have built it in the schedule though, but let me just do it down here. So share split. So 2-3 by the existing shares outstanding, 6 million. So from the 1st October, how many shares will then be in issue? 2 new for 3 existing. That'll be 4 million. So from 1st October, our shares will be reduced to 4 million. Then, stay with me carefully as we build a story. There was no special dividend, share repurchase, or other outflow of resources. There was, having completed the consolidation of shares, a new share of 600,000 shares, a new share issue for 600,000 shares was made through an offer for sale at a market price of 155 per share. So after this share split that we just saw on 1st Oct, they now did a 600,000 issue. The question is when? So let's continue. The allotment was made on 1st March 2025, and the proceeds were due on 1st April 2020. Now, when it comes to recognition of shares, shares are recognized on the date payment is received, not when it is allocated. So the date of payment or receipt of the payment will be the date on which we will say, yeah, you have bought the shares. Because if we are recognizing the shares on allocation and you never bring the money, and that is not a contract like, oh, we have to make a first call, a second call, a final call, or in that order, then you don't have the shares. So until you pay for it, you don't have the shares. So although allocation was done on 1st March 2025, proceeds were due on 1st April. So the 1st April becomes the date for our decision making. So we will run this 4 million from 1st October 2024 to 31st March 2025. And so October, November, December, January, February, March, that is 6 months. Then on the 1st April 2025, they are issuing 600,000 shares. So from 1st April, how many shares will now be in issue? The 600,000 new plus the 4 million from 1st October, and that becomes 4.6 million. Right? So the 4 million earlier plus the 600 now will give us the 4.6 million. So April, May, June, which is the year ended, it's going to be 3/12 as well. 30th June 2025. That is the workflow. Let's continue. Then we are giving the financial statement. So again, Zabzugu, a parent entity, had 6 million shares. So at the beginning of the year, 1st July. So you got to be careful here because he says, oh, the shares outstanding was on 1st June 2024. But remember, our year ended is 30th June 2025. So if the year ends in June, then it starts on July. So although they said 1st June 2024, that was in the previous accounting year. So at the beginning of the current accounting year, which will be 1st July, we had 6 million shares. Then in October, on 1st October, something happened. So July, August, September. We do the workflow there for the period, and then that is going to give us the 3 months over 12. Then from 1st October to 31st March, That was where the share split came in. Again, get a concept of the share split. It is a reverse share split. So now, if you had 3 shares, you are going to be getting 2. And so from the 1st of October to 31st of March, we now have 4 million shares because there has been a reduction in the number of shares because of the reverse share split, and they are doing the consolidation of the shares. Then on 1st April, they issued new shares. Although allocation was done on 1st March, proceeds became due on 1st April. So as always, we recognize the shares on the date that the proceeds become due, not on the allotment date. And so that's 600 plus the 4 million from 1st October becomes 4.6. And April, May, June, that is going to be 3 months there. That is the idea about the workflow. But this is one thing you must understand. This reverse split here, which was done on the 1st of November, as indicated here, a reverse split at nominal value. Remember, we were told that no special dividend were given. There wasn't a share exchange or any other forms of cash flows. So it is like we are giving them new class of shares for no money. And so what is then happening is that there is a bonus there because we are giving them a new class of shares and then they are not paying anything for it. So there's going to be a bonus fraction. Okay? There's going to be bonus fraction. And so in this scenario, the bonus fraction is going to be the number of shares after the issue divided by the number of shares before the issue. So number of shares after the share split divided by the number of shares before the split. Okay, so if you check the workflow very well, what do we see? We see then that it was 2 new for every 3. So after the issue, you now have 2 shares. But before the issue, you had 3 shares. So the bonus fraction is going to be 2 over 3. Now, bonus fraction applies to shares prior to the right issue. So anytime we are dealing with earnings per share, whether there is a share split, there is a bonus issue, or there is a right issue, these will result into bringing in bonus fraction. And there is a way they are all calculated, especially under right issue, the bonus fraction calculation is different. But the application of the bonus fraction is that it is going to be affecting only shares prior to the right issue. So since the split was done on 1st October, the bonus fraction will only affect the shares at the beginning of the year, which is the 600,000. And that is the workflow there. We multiply up, so the outstanding shares, multiply by the timing ratio, multiply by the bonus fraction, gives us the average. So let's look at it. 6 million. 3 over 12, 2 over 3. And that is 1 million. Here. Then the second one, that is no brainer. That's going to be 2 million. Then the third one, 4.6 million. And that is 1150. There we go. So we add the 3 up, and that gives us the weighted average number of equity shares. So that'll be 3 million, that'll be 4,150,000. So this is the weighted average number of equity shares calculation under the context of this particular question. Right? Under the context of this particular question. But we are not done because the examiner says calculate basic earnings per share. But to calculate the basic earnings per share, we need a weighted average number of equity shares. So now that we have that, we can look at the scenario here. Now, if you check closely, you can see the financial statement, the company summarized statement of profit or loss for the year ended 30th June 2025, as published, is shown below. And so we have it coming here. Loss for the year. So it wasn't like they made a profit, they made a loss, but we're going to work it out anyways. So the loss for the year, that's what we'll be interested in. It says the company also had an issue 500,000 of 5% cumulative redeemable preference shares throughout the year ended 30th June 2025. Earnings per share relates to equity shareholders, not all shareholders. Please get that very well. Earnings per share is about equity shareholders, the true owners of the business. So yes, the entity is having redeemable preference shares. But redeemable preference shareholders are creditors of the company. They are not owners of the company. So the shares they have does not affect our calculation of the earnings per share redeemable, because even the interest payable to them will be included in the finance cost, or dividend payable to them will be included in the finance cost there that we need to know about. And so for that reason, that's not going to come. Now, there is a little thing that you must understand, especially if you're in corporate reporting, possibly. We have what we call redeemable preference shares and irredeemable preference shares. Normally, the assumption is that the interest payable to the redeemable preference shares will be forming part of the cost of finance or finance cost in the P&L account. However, the interest or dividend payable to the irredeemable preference shareholders will be treated in the statement of changes in equity. And that is a key distinction you have to draw. But in the context of this scenario, that is not going to be our headache at all here. Then, so this is the loss for the year, 448. But I need you to pay attention closely to what is happening here. You can see profit or loss attributable to. Remember, this whole question is in the consolidation environment, not a single entity. Because if you check earlier, we were told that the entity made a consolidation of existing shares. Not even that, but you are seeing here, they said owners of the parent non-controlling interest. Owners of the parent non-controlling interest. So it tells you that we are in a consolidated environment. And so if we're in a consolidated environment and we are calculating the earnings per share, then the earnings per share will be based on the owners of the parent entity, their share of profit or loss that is attributable to them. And so for that reason, our basic earnings per share, it's going to be, in this case, it's a loss, no P. So we can say the loss per share if we want to. So that is going to be how much? 478. Is this figure working in million or, okay, in thousand? 478,000 divided by the number of equity shares we calculated, 4,150,000. So we punch that out. 478,123 divided by my answer. And I'm getting an answer of, okay, let me punch that again. 478,123. 4,150,123. So I am getting in CD terms 0.115, okay, Ghana Cedi loss per share, because it's a loss. But remember I told you something earlier, that we could multiply by $100, £100, 100 Ghana cedi, so that we can get the answer in the smallest unit of the currency. And so what we can do is to multiply this by 100 Ghana cedi. Not 100%, 100 Ghana cedi. And so if we are multiplying by 100 Ghana cedi, our answer times 100, it means it will be 11 point, maybe 52 pesos loss per share. So this is the answer to the question. So you got to be mindful here. Yes, we are in a consolidated environment. Because how do we know we are in a consolidated environment? Because it is only in consolidation that you have, profit or loss attributable to owners of the parent and the non-controlling interest. So we need the owners of the parent entity. They are profit attributable to them. That is what we will use in the calculation of our earnings per share. Then number 2, we see there is cumulative preference shares here, but that is cumulative redeemable preference shares here. But that is inconsequential to our workflow because any returns payable to them will be included in finance costs for the most part. And then the third thing is that our focus in earnings per share is calculating the profit or loss attributable to the equity shareholders of the entity. The equity shareholders of the entity. So that is the answer to this question. 5 marks, 9 minutes for the most part for you to work here. And that is earnings per share, IAS 33. Basic earnings per share. All right? Basic earnings per share. Okay. So let's go to another question that is going to take us on a journey of IAS 12 and IAS 16, property, plant, and equipment. And let's see how the pieces can be added together. So that one is going to be, I think, in March 2025, corporate reporting. ICAG, March 2025, corporate reporting. We're going to question 2A. Quite a lengthy question there for 6 marks. So technically, we are working for, I think, about 12 minutes or so, 1.8, 11 minutes rather. 11 minutes. So, I keep on saying this, that you have to be able to work with speed and accuracy. And the only way you can work with speed and accuracy is building your understanding of the concepts, of the principles. And that will require you to really study and understand the principles well. If you read and you're now going to be scratching your head or trying to, chew your pen before something jumps into your head, by the time you realize you have failed the examination. So look at this question. Even reading alone is going to take some time. But here you are, per the marks allocation, you are supposed to use 11 minutes. So speed, accuracy, processing the information as you read spontaneously like that, and making sure that you're not losing your grip. Because if you do, au revoir, mon ami. So let's see what we got here. Required. Using the financial statement extracts, set out the accounting treatment of the above items in accordance with IAS 12 income taxes. Now, the requirement of this question is interesting. It says we should set out the accounting treatment. It means here that you have a number of options available at your disposal. You can do whatever workings there is to be done and then extract financial statements. All right? Extract financial statements. Or do the workings that has to be done and then enter the journal entries with explanation. Because here it just says Using financial statement extract. Okay, using financial statement extract. Myself, I've missed it. So we are supposed to extract the financial statement at the end of the day, set out the accounting or financial accounting treatment of the above transactions in accordance with IAS 12. So we're going to be doing the two. I'm going to be extracting the financial statement. Then also we'll be walking you along with the double entry principles, because it is important we know this alongside as we go. So let's see what we got here. Amugi, a public listed company. So let me go into my slide. Amugi. There we go. A public listed company is a producer of soft drinks. Recently, Amugi has been experiencing financial difficulties attributed to a recession. Extract of statement of financial position and statement of profit or loss for the year ended 30th June 2024 are as follows. Are as shown below. Now, in the requirement of the question, we were not told the year ended we are supposed to work as per the requirement of the question. But seeing that we are given the extract financial statement for 30th June 2024, we can conclude then that we are working for the year ended 30th June 2024. There. So let's see what we have. The statement of financial position is here. We see property, plant, and equipment. We can see deferred tax liabilities here. Current tax, there is a dash there, nothing. Statement of profit or loss. Okay. We see the loss before tax. We see the loss for the year, and there is nothing under tax, because these are extracts. Now let's read the information below. The carrying amount of land and building included in property, plant, and equipment in the draft financial statement above was 144 million Ghana cedis. So included in the property, plant, and equipment we are seeing above here, this particular figure, is property, plant, and equipment. Stay with me. Depreciation for the period of 14,400 on property, plant, and equipment has already been accounted for. Okay, no problemo. The market value of land and building as assessed by professionally qualified valuer was 151.2 as at 30th June 2024. Oh. Gain and losses on properties are taxable or tax deductible on sale. Okay. So quickly, what is going on here? Something is going on. So let's set our slide up. So we see the carrying amount of the land and building. At the year ended, let's tell the examiner we'd like to work 3 zeros up, is 144,000. Then we bring the revalued amount of same at the reporting date. So it means here revaluation is being done at the reporting date. Because remember, revaluation can be done at the beginning of the year, within the year, or at the end of the year. And it is important you understand that after revaluation, depreciation is calculated using the revalued amount. So the revalued amount is 151,200. So it means the asset has gone up in value, and that's going to give us revaluation surplus, which will go to OCI. Okay? Which will go to other comprehensive income and revaluation surplus on the face of the statement of financial position. So 144,151.2, and I'm getting 7,200. So that is the revaluation surplus. And so now on the face of the statement of financial position, what is going to be happening is that we are going to be carrying the building at this amount on the face of the statement of financial position. And then we'll do the adjustment in a moment, so you see. Now, when there is a revaluation surplus, let's pass a journal entry. So the asset has gone up in value. So we're going to debit property, plant, and equipment with a figure 7,200. Then we will credit other comprehensive income and revaluation surplus. So we credit revaluation surplus as well as OCI, 7,200. But I need you to pay attention to the last sentence in that paragraph. Gain and losses on property are taxable. So what it means then is that this revaluation is going to result into a deferred tax liability because there is an upward revaluation here. So, and when there is the movement in deferred tax, and a portion of that movement is coming as a result of revaluation of assets, then the deferred tax component relating to the revaluation part will go into the other comprehensive income, not in the P&L. You know this. I'm going to be coming back to that in a moment. So that is the first paragraph. So far, we don't know the tax rate. So let's continue to read and see what we have here. The tax base of all property, plant, and equipment at 30th June was 150.48. That's the tax base. Okay. Losses incurred in the year ended 30th June 2024 that can be recognized for tax purposes after taking into account disallowable expenses amounted to 23.404 million. Okay, so that is the loss estimate for the year. And so, you know, when an entity makes a loss like that, we still have to calculate the tax though, but here the tax is going to be positive because the entity would then get a refund from the tax authority because they've made a loss. So they're going to get a refund on this 23.04 million from the tax authority. And we'll come back to that in a moment. That is why you realize that in the statement of financial position presented here, under current tax, it is dash. Because if you make a loss for the year, it does not mean you won't calculate any tax. As they have not calculated here in the P&L account, it means that there will be a tax refund from the Ghana Revenue Authority or the tax authority. So in that case, that tax refund figure will come under current asset. If you are supposed to pay tax because you made taxable profit, it comes under current liabilities. But if the tax authority is supposed to give you a refund because during the year you made a loss, as we can see in this case, it is tax refund. It will be positive under the tax account, in the P&L account to increase our profit generically, and then it will be part of current assets. It will all come together in a moment. Stay with me with the principles. In the industry in which Amugi operates, tax losses can be carried back for 3 years and then carry forward indefinitely. Okay, that's good because carryover of losses is there and you can even carry back losses. It means if you made a loss this year, you can go back last year, you made a profit and write that loss off against some profit you made last year, and then that will help you to reduce your overall tax liability. Amugi made a profit in the previous 3 years sufficient to absorb the current year tax losses. Amugi pays tax at 25% and the tax losses will be applied at that rate. The rate is not expected to change. The rate is not expected to change. So let's put few things together. So when it comes to the current tax issue for the year ended under review, at 30th June 2024, as we mentioned, they made a tax loss of 23.4. So that is 23,040. And so income tax expenses is going to be $23,040 times the rate of 25%. So let's see what we got. And that is 5760. And so, as we mentioned, this will be credited to the P&L account. So it will come. So in the income tax figure, it will not be negative, but it will be positive. But stay with me. So journal entry. We're going to debit the current tax asset. Or as I said, it could be a tax refund, and this will be under current asset on the face of the statement of financial position, 5760. Then we credit profit or loss, but not like you are crediting profit or loss like it is coming like as an income item. It will be reducing how much income tax expenses we'll be charging for the year. So it will actually affect the income tax figure 5760. Very important. Then, so that is the current tax. Now let's deal with the whole assets issue there. So we bring in the carrying amount of the asset. So carrying amount of property, plant, and equipment. Give me a sec. I want to tell the examiner that if he sees PPE, it represents something just for professional presentation purposes. Okay. Want to do that. So PPE. So that when the examiner sees PPE, he knows what it means. Although we expect him to know what it means. Okay. Professional presentation. So the PPE, stay with me carefully. The carrying amount of the PPE as reported was 214 and 80. But remember the revaluation surplus that arose from the land and building 7,200. So it means now all the property, plant, and equipment will be carried on the face of the statement of financial position as Ebaze 72214 and 80. That will be 221 280. Then we bring in the tax base. The examiner gladly gave us that, if you remember, 150 480. Okay, so what do we see? We see here that, permit me, I'm going to take this to the next slide so that I can work the way I want to work. In the exam, or you don't cancel and go to the next slide. Just continue in the next page. But I can do that. So if the carrying amount is more than the tax base, what do we have? Taxable temporary difference. So we go to taxable temporary difference of how much? Minus 150 480. And that is 70,800. So this taxable temporary difference is going to lead us to calculate the deferred tax liability brought down. At the end of the year. So that is going to be 25% on 7,800. And that is 17,700. Stay with me carefully. So this is the closing deferred tax liability that will go under non-current liability in the statement of financial position. Okay. Do we have opening deferred tax? Okay, let's see something. There's a last sentence there. The deferred tax liability in the above extract statement of financial position is the figure at 1st July 2023. Our year ended is 30th June 2024. So it starts on 1st July 2023. So that is the opening figure. So go back up. This 13,080 is the opening figure. So deferred tax liability brought forward 13 and 80. So it has gone up, movement in deferred tax. So gone up by what? 4620. But this is what you must understand. By default, for the most part, the movement in deferred tax would have gone to the P&L account. But not this time. Why is that so? Because part of this movement in deferred tax is coming in because of the revaluation of assets. And so we must split this movement in deferred tax into P&L and OCI. The amount that goes into the OCI will be based on the revaluation surplus figure. And so charge to other comprehensive income will be 25% on the 7,200. So 72, 0.25. That's 1,800. You take it out. So that the balancing figure is the amount of deferred tax that you are charging to P&L. Okay? Minus 4620, and that is 2820. This is the workflow. This is the workflow. Now, so if you pay attention closely to what is happening, especially about the movement in the deferred tax, you are actually going to be debiting profit or loss, but you are not debiting profit or loss like it will come there as a line item. It will be written off against the income tax expenses, which the 2820. All right. Then you also debit the other comprehensive income, as we've mentioned, with the amounts that you are charging to the other comprehensive income, as well as the revaluation surplus, with 1,800. So that the total amount is credited to deferred tax liability, which will go under non-current liability. 46, no. Is that a figure? Yeah, 4620. That's the workflow. So if you pay attention closely, earlier, you had credited the P&L with 5760. Now you are debiting the P&L with 2820. So you know the net figure of that will go into the P&L account in respect of the taxes. So these are the workings. I think we are done reading. Yeah. So these are the workings we can do in respect of this question. Now let's extract the financial statement so we see how this will be at play. So we see the first issue, then the deferred tax issue. Now let's extract the financial statement. So, Amogi, let's do statement of profit or loss and other comprehensive income. What did they prepare? They prepared only profit or loss for the year. So, I don't know. Should we prepare same or, yeah, we can prepare same as they have or extend it a little bit, no P. So statement of profit or loss, and other comprehensive income. And this is going to be an extract for the year ended 30th June 2024. There we go. So we're going to start first with a profit or loss segment. So in the profit or loss segment, let's go back into their financial statement. You can see gross profit here. So we're going to pick that. And that is 189,000. Then we less the distribution cost. Which is 200 and 520. So we take this out. 189, 200, 520. That is 11, 520. So that will be loss before tax. Okay. Then we go and bring in income tax. You realize earlier that in their financials, they had dash on income tax. But based on our workflow, income tax will not be dash. So stay with me. We are just debiting the income tax with 2820, the deferred tax movement, and we are crediting the income tax with 5760. Now, crediting P&L income tax is positive. Debiting P&L income tax is negative. So we can bring the positive to say 5760 minus 2820. So the income tax figure is going to be positive here. That is 2940. Okay? So it's not every time here that your income tax charge for the year will be negative. Sometimes it will be positive, like as you are seeing in this case. Why is it positive? Because they made a loss during the year, as we calculated earlier, and on that loss, they are going to be getting a tax refund. That means that refund must be accounted for by debiting tax refund, as we have done, under current assets, and crediting the income tax account in the P&L account there for us. So you add it up, and then, remember this is a negative. Got to be careful. So 11520. So 8580. Yeah, it's still loss, but, you know, it's a higher loss now. So loss for the year. So that is the profit or loss segment of the financial. I'm adding the OCI because I want you to see how it will look like. So other comprehensive income. So in the other comprehensive income, we'll bring the revaluation surplus. In the flow from the workings. I didn't even number my workings, right? I could say this is workings 1. Then we did workings 2. Then all these could be workings 3. So revaluation surplus, 7,200. Then you bring in the deferred tax. That has to go to the OCI. That's coming in from workings 3. The deferred tax we are debiting to OCI, 1,800. This is the statement of profit or loss and other comprehensive income in the context of this question. Then let's go to the statement of financial position. I'm going to put it on the next slide. So statement of financial position. Also an extract as at the year ended for the period. So in the statement of financial position, let's first have non-current asset. So under non-current asset, we'll still have the property, plant and equipment. And that is going to come from the figure we work for in the third year here. Because the carried amounts will now be, the amount at which you will carry it will be the 7,200, the revaluation surplus coming in from the land and building, and then the issue in respect of the carrying amount. So 221,280. That's the non-current asset. Then under current asset here, as we mentioned, the current tax, which can sometimes be called tax refund, will be here. So current tax, or sometimes referred to as tax refund, because the tax authority owes us this. And that's coming in from the workings we did in workings 2, 5760. All right, 5760. There we go. Then we go to equity and liability. So under equity and liabilities, first we're going to have equity. Under equity, we'll have the revaluation surplus coming up, as we did earlier in workings 1, the 7,200. Now, stay with me. The revaluation surplus, remember in the OCI, you brought the deferred tax in the OCI. So that must also be subtracted because, you see, the movement in deferred tax must affect equity. So the one that was taken to the P&L, loss for the year, will affect retained earnings. So the one that goes to the OCI must also affect the revaluation surplus. So it means that the carrying amount of our revaluation surplus will be the 7,200, which is the revaluation surplus, minus the tax, 1,800, the deferred tax. That was taken to OCI. And this is a crucial thing you must understand, 5,400. So the carrying amount of the revaluation surplus at the reporting date will be 5,400. The revaluation surplus minus the deferred tax component that was taken to the other comprehensive income. So that is what comes under equity. Then we can bring in the liability or liabilities because we have both current and non-current here. So the non-current liability will take the deferred tax issue, the new figure that we worked for at the reporting date here, 17,700. All right. Then, okay, that is all because the current tax has been brought under tax as a tax refund because we were not supposed to be paying tax or we are not liable for the payment of taxes. So this is the answer to the question. Quite a lot of work, right? For 6 marks to be done 11 minutes. All right? So that is the presentation. Again, I keep on telling you about professional presentation. Professional presentation. Because that is going to play a crucial role. So that is the first thing for the presentation. The second thing for the deferred tax situation. And then the P&L and OCI extraction, which is the core thing in the question. They said using extract of financial statement. Then the statement of financial position. These 4 things, 4 slides you've seen, plus reading the question, all in 11 minutes. So if you're not somebody who has solidified yourself, or if I can put it even this way, who has fortified yourself with the accounting standards, so much so that immediately you read You know the principle to apply based on the context of the question, because you are going to be holding your breath and you're going to be interpreting the thing gradually as you go. Then you're going to struggle in the exam hall. But that is the answer to the question, and that is the idea about IAS 16, property, plant, and equipment, and then IAS 12. So although there is a little IAS 16 here, the main theme of this question was the IAS 12 part, where you are looking at the issue about taxes, and that is what you must understand for this question as well. This is corporate reporting, right? So certainly the examiner demands a little, more work than regular in financial reporting, but the law is the law is the law. Principle is principle is principle, and you need to be able to know how to apply the principles in a given question. So that is it about that, and this is what time will allow us to discuss today. God willing, Friday, same time, I'll be coming on, and we will continue with the discussion. So we've looked at something on IAS 33, basic earnings per share, especially the calculation of the weighted average number of equity shares when there is a reverse share split, and how the workflow is to be done. And then certainly the issue about IAS 12 income taxes and how they are accounted for. On Friday, God willing, I'm going to be coming your way, and we are going to be continuing with the discussion. Note also that on Saturday, we're going to be having a special session on Saturday, because we have some special announcements to be making that we'll be making on Saturday at 7 p.m. also. So you make sure you make a date and then join the stream as well, because we have some interesting announcement to make, and then you will also get some opportunity to be able to benefit and even join our community to study under my mentorship at a fraction of the cost, generally in that case, so that you can really put yourself in the position to go into the exam hall, write the exam with confidence, and most importantly, pass the examination. So thanks for joining us today, and I'll see you same time on Friday as we continue with our discussion towards the November 2025 examination. Remember, it's all about the principles. It's all about the concept. Once you understand the principles and the concept well, you now have to expose yourself to questions. If you expose yourself to enough questions, you'll be able to see how the principles apply in various circumstances. Then you need to practice holding your breath, reading the question, interpreting the question as you go, being able to call the principles spontaneously as quickly as possible, so that it can work with speed and accuracy and put you in the position to pass the examination. So I'll see you same time on Friday as we continue with our discussion. Stay blessed.